I think around the world, I mean, we're going to see resumption basically of, I've called it the gradual print. It's like slow debt monetization. So we've had really from 2022 through 2025, many central banks have been consolidating their balance sheets. We've seen it from the Fed, we've seen it from the ECB, we've seen it from the BOJ. I think that's kind of bottoming out. We've already seen that bottom out from the Fed. I think we're going to see it bottom out from other major central banks and go to gradual balance sheet increases, which, it kind of is like growing their balance sheet in line with nominal GDP and monetizing a fraction of the debt. But those things tend to multiply because as you monetize a fraction of the debt, you increase the monetary base, you increase the overall amount of cash in the commercial banking system, which means that when you maintain certain capital ratio requirements or reserve requirements, whatever the case may be by country, it means they can keep lending more without running into either liquidity constraints or capital constraints.
For the past 2 years, markets have been navigating one of the most aggressive tightening cycles in modern history. Central banks pulled liquidity out of the system, shrank their balance sheets, and tried to regain control over inflation. But according to macro analyst Lyn Alden, that phase may already be coming to an end, and what comes next could reshape everything. In this interview, Alden outlines what she calls a gradual print, a slow but persistent return to money creation across the global economy, not just in the United States, but across Europe, Japan, and beyond. It's not the explosive stimulus of 2020, but something more subtle and potentially more powerful over time. A steady expansion of central bank balance sheets, quietly increasing the amount of money flowing through the system. And here's where things get interesting. Over the past few days, Bitcoin and the broader crypto market have started to move higher again. Not dramatically, but enough to raise eyebrows. Because historically, crypto has been extremely sensitive to liquidity. When money supply expands, risk assets tend to follow, and the market may already be starting to price in what Lyn Alden is describing. Alden, known for her deep macro research and long-term market frameworks, breaks down how this new phase of monetary expansion could unfold, how money actually enters the system, where it flows first, and why some assets benefit more than others. If you want to understand what's really driving the next cycle in crypto, this is a conversation you can't afford to miss. So, in this video, we're going to break down her key insights, how money is created, how it moves through the financial system, and what it ultimately means for Bitcoin, inflation, and asset prices going forward. If you enjoy deep macro breakdowns like this, make sure to like the video, subscribe to the channel, and turn on post notifications so you don't miss what's coming next. Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time. Thanks for tuning in, and enjoy the video.
Really, ever since the global financial crisis, bank lending slowed down for a period of time. Partially, it's because just risk appetites changed, and partially it's because new regulations came in that just kind of added more constraints on lending. So you had slower bank lending that was offset by larger, on average, fiscal deficits, some of which were monetized. Kind of the two main ways for broad money creation really are fractional reserve bank lending. Basically, when banks have a higher, they lend more relative to the amount of reserves they're keeping in place, or the government they spend money into the economy, and instead of extracting it all from taxes or debt issuance, they have the central bank monetize part of it. Or the hybrid, of course, is when a commercial bank will buy some government bonds on its fractional reserves. And so those are ways that can kind of increase the broad money supply. And as you point out, I mean, because there's been tighter kind of bank regulations and because there's just been more conservative lending since the global financial crisis, we have seen a rise in private credit. And it'll be called shadow banks. It'll be called non-deposit financial institutions more broadly. That can include private equity and certain other things. But the private credit component, the interesting thing is that On its surface, private credit, especially the term shadow banks, sounds bad. It sounds like dangerous. On surface, what they do is actually in some way safer than a bank because instead of lending out someone's like demand deposits into illiquid loans or taking a business's like payroll, like checking account and lending it out into illiquid loans and sometimes saying, oops, we can't necessarily pay you back right now, like say Silicon Valley Bank. Um, these private credit funds are saying, okay, well, you're a high net worth investor or you're an institution, a pension or an insurance company or whatever the case may be. You've got long-term capital you want something to do with. We're making loans to businesses or consumers at, 10% a year. And so, you can give money to us and we'll lend it out. By the way, unlike a bank account, there's no promise on liquidity, right? We will try to provide liquidity when requested, but we're making illiquid loans with this is savings. It's not like a demand deposit. It's not near-term savings. It's an investment. So we will try to make liquidity available upon request, but no guarantees. And so it's actually closer to full reserve banking in many ways. Now, the downside is it's more opaque. It is less regulated. So on average, you're going to get a riskier loan type in there, which is why banks aren't doing it. And then the way that banks participate is in that risk reduced way. So they say, okay, we're not going to make those types of loans, at least at scale. And we'll let those full reserve shadow banks do it. But while all those private credit funds are taking all that kind of private capital, they also go to the bank and say, hey, can we borrow at 7% for a quarter of our funds? And it's collateralized by all of our lending. And the bank says, sure, because the way that works is that allows a credit fund to say, let's say an average, they make 10% yielding loans. They could potentially earn 12% net returns because they're borrowing some of that money at, say, 7%, lending it out at 10%. They're making an additional spread. So, if you're investing well, then leverage can be, conservative leverage can boost it. Obviously, it can go bad when things are going wrong. And from the bank's perspective, we see a lot of headlines around private credit not doing great at the moment. When private credit defaults occur, the by far the first in line are all those investors, all those high net worth investors, insurance companies, pensions, other institutions that put money in, and now they're at risk of losing some of it, or sometimes they want to withdraw and they can't just because it might still be solvent, but not everyone can withdraw at the same time. But let's say you have actual defaults occur at scale, they start getting impaired. But the bank is still protected because they're not, they weren't investing in the fund directly. They were lending to the fund, which puts them higher in the capital stack. And so the private credit fund would have to have pretty massive losses to get to the point where they can't pay back the bank loan. And then you look at things like, well, what percentage of all bank assets are in private credit? Broadly speaking, banks have lent 1.9 trillion in the U.S. to non-deposit financial institutions, it's a lot, but that's out of 25 trillion in total bank assets in the U.S. So it's 7 to 8% of total bank assets are lent to non-deposit financial institutions. Of that, not all of that is private credit, but something over a trillion of that will be categorized as private credit in various ways, which means that you'd have to have pretty massive losses to start ricocheting into the actual core banking system. And even then, the numbers they likely would receive, other than maybe some banks you haven't heard of that are just oddly exposed, but all the big players, they generally have pretty conservative exposures. So they might take a hit here and there, but it doesn't render them insolvent. So we have this, you can kind of call a three-tier banking system. It's obviously the central bank, that's the base ledger. You've read the book on layers. Basically, in this context, we have that base layer. We have a commercial banking system on top of that fractional reserves, it makes loans. And then we have this tertiary layer that banks can lend to that can then re-lend in a riskier way that kind of reduces risk to the second layer, the banks. Where things like SLR and other changes come into play is that as the government debt keeps growing, as we hit 29 trillion and add 2 trillion or so of public debt each year, someone has to buy all those treasuries. The foreign sector is not buying as big of a share as they used to. Their nominal amount is increasing, but they're not buying as big of a share as they used to, in large part because the debt is growing faster than total trade is. So there's just not that many cash flows to reinvest into those treasuries, which means more of it has to be bought domestically. Um, Unlevered balance sheets can only buy so much. So insurance companies can only buy so much, and pensions can only buy so much, and individuals can only buy so much. So leveraged balance sheets like banks can buy a lot more. But they have various constraints on, how much duration they can have on their balance sheet, for example, and those numbers are negotiable. So how much treasuries, for example, count against a bank's overall kind of risk-weighted capital requirements is a regulatory number that can be adjusted. And recently, the Fed basically reduced SLR requirements so that effectively it lets banks hold a little bit more treasuries without being penalized, is one way of putting it. And so you can kind of say, okay, well, all this has to be bought. The Fed's going to buy some, commercial banks are going to buy some, non-bank entities like households, insurance companies, pensions, other pools of capital, they're going to buy some. And wherever you kind of get issues, you can toggle a few things. The central bank can buy a little more. That's why we've seen a shift from balance sheet reduction to balance sheet increases. But they can also say, well, how can we help the commercial banking system buy more without taking on too much duration risk so you don't look like Silicon Valley Bank? Well, around the margins, you can tweak the supplementary leverage ratio to let them absorb a little more, and kind of go from there.
What Lyn Alden is really highlighting here is a structural shift in how money is created in the modern economy. After the global financial crisis, traditional bank lending slowed down significantly. Regulations tightened, risk appetite dropped, and banks became far more conservative. But the demand for credit didn't disappear, it simply moved elsewhere. That's where this rise of private credit and so-called shadow banking comes in. These institutions are stepping in to fill the gap, creating liquidity outside the traditional banking system. And when you combine that with ongoing government deficits and selective debt monetization, you start to see how the money supply can continue expanding, even without aggressive central bank stimulus. But this leads directly into a much bigger question. If debt continues to grow at this pace, and someone always has to buy it, who ultimately absorbs that supply? And more importantly, what happens when the system increasingly relies on monetary expansion to sustain itself?
What is your view on the path from 40 to 50 trillion and inflation over that time period in the United States?
Good question. And I mean, for context, I've been comparing the 2020s to the 1940s since the beginning of the 2020s. And it's already been directionally similar, which is that we've had inflation much higher than yields. Anyone holding currency or bonds got absolutely killed compared to anyone holding equities, real estate, gold, Bitcoin, high quality private equity, and fine art, things like that, right? Basically, we've kind of partially recollateralized balance sheets by devaluing a lot of this. And it's not due to, so in the 70s, a lot of the money creation was from bank lending. You had the baby boomer generation entering their home buying years, their peak credit formation years. So you had a very big generation borrowing a lot of money combined with material shortages of energy. And so you got inflation from that. What the 40s and the 2020s have in common is that it's more from monetized fiscal deficits rather than large-scale bank lending. And these things operate on a lag. So most of our monetized fiscal deficits were in 2020 and 2021, at least the monetization part. But that takes time to spread through the system. So the 2020, giga stimulus didn't really start impacting until 2021. The 2021 giga stimulus was kind of impacting later. Then, of course, we got war in Europe, so that put a kind of temporary inflationary factors on energy and other kind of food materials. But even since then, even after the Fed started getting more hawkish, even after we haven't really done separate stimulus in the U.S., there's the Inflation Reduction Act did some stimulus, not really the type of quick acting type, but a lot of that still, that money supply that was created still kind of worked its way through prices. So even things like just the price of insurance going up, let alone the price of food and just other things. Eventually housing kind of settled down because obviously we had a boom in like apartment renting, and then eventually that kind of stagnated, but then it caught up elsewhere. So it takes time for that to work its way through the system. And it's not even because there are supply shortages in some areas and not others. We can always make more software, but we can't necessarily make more gold or more waterfront property. So you're going to get disproportionate price increases in response to all that money creation. And what we have, let's say, putting the latest crisis aside, we've got a more gradual situation again, which is we have in the US, we have top heavy demographics. It's also true for large portions of the rest of the developed world. In older times, aging demographics could be disinflationary because the average 70-year-old will consume less than a 40-year-old with children and kind of is upgrading their consumption. But when you have a larger portion of the population that's not currently working, but then we do have pretty robust entitlement systems. So in the US, I mean, obviously per capita healthcare costs are extremely high, Social Security is happening. That money is getting out to seniors and being spent into the economy, whether it's restaurants, whether it's travel, whether it's, and even other things like funding their grandkids' wedding and hiring all the services that go with that, or helping their kids buy their first home. That is capital that is not quite with the speed of a stimulus check, but that is capital that is getting into the broader economy. It's going into healthcare, and then all those healthcare workers are spending into the economy. It's going into defense, and all those defense workers are spending into the economy. So we're kind of gradually kind of stimulating in a way. Now, for a number of years, it wasn't being bought by the central bank. It was being bought by commercial banks. It's being bought by other balance sheets. Now we've kind of gone back to that hybrid approach. And so we are going back to broad money supply growth. So that kind of money creation side is inflationary, but then it's offset by productivity growth, right? So if you look at the long arc of time, I mean, in the US, money supply growth is average, say, 7% a year. If you have, say, 3% average productivity growth every year, then the net result is you're likely to end up something like 4% price increases. And those won't be evenly distributed because you don't get equally productive at, you get more productive at making plastic toys and TVs than you get at mining new gold, for example, right? So you get disproportionate disinflation in the things we get way more abundant in, and you have most of the price increase show up in the things we don't get much better at making. So going forward over the next, say, 5-10 years, I think we're going to, again, putting crises aside, because a lot of them are unpredictable. I mean, it's unclear how long the current one's going to last. I think we're going to have ongoing large defense spending, ongoing large entitlement spending. It'll be monetized where needed or absorbed by the private sector where possible. And that'll keep spilling out into the economy, keep growing money supply. And then it's going to be partially offset by productivity growth, right? So we talked about AI should keep a lid on a lot of white collar services, even though you have money supply growth. So where does it show up? I mean, depending on how scarce energy is over this kind of period of time, it can show up in energy inflation, and therefore energy finds its way into all sorts of goods and services, transportation, all this. It can show up in things that we're just not making much more of. I mean, no matter how much money we create, we're not making more Bitcoin than the current protocol allows. You're very unlikely to rapidly increase gold by the typical rate that gold increases. There's a real cost of building houses. I mean, there's abundant land, but there's NIMBYism. There's many kind of just frictions against just rapid house creation, including just, there's materials and labor involved. Obviously, some scarcer than others, waterfront compared to just, suburban kind of sprawl. And so I think that over time, we will continue to see inflation. It'll show up in what is scarce. Some things become temporarily scarce. Other things are more persistently scarce. And it'll be offset by the areas that are not scarce. So throughout the 80s and 90s and 2000s, that was kind of manufacturing and electronics and Moore's Law. I think part of that will continue. And then more recently, it'll show up in just kind of white collar wages and white collar services staying relatively cheap, despite the growth in money supply, because that's not the bottleneck. That's the productivity offset.
What Lyn Alden is describing here isn't just a short-term cycle. It's part of a much longer monetary trend that has played out multiple times throughout history. When governments accumulate large amounts of debt, there are only a few ways to deal with it. You can default, you can drastically cut spending, or you can gradually inflate it away. And more often than not, policymakers choose the third option. This is what money printing actually means in practice. It's not just central banks creating cash out of thin air. It's a coordinated process where fiscal deficits are funded, directly or indirectly, by monetary expansion. The central bank increases its balance sheet, liquidity enters the banking system, and over time, that money spreads through the economy. Not all at once, but gradually, impacting prices, wages, and asset values along the way. We've seen this before. In the 1940s, the United States ran massive deficits to fund World War II, and much of that debt was effectively monetized. The result wasn't immediate hyperinflation, but a prolonged period where inflation ran higher than interest rates. That meant savers and bondholders quietly lost purchasing power, while real assets like equities, real estate, and commodities significantly outperformed. And that's exactly the parallel Alden is drawing to today. When money supply grows faster than real productivity, the excess tends to flow into scarce assets, things that can't easily be created. That includes commodities like gold, hard assets like real estate, and increasingly digital assets like Bitcoin. Because, unlike fiat currencies, their supply is constrained. At the same time, not all prices rise equally. Technology and productivity improvements can keep certain sectors relatively cheap, while scarcity drives others higher. That's why we see this uneven inflation, where everyday costs rise, but certain services or goods remain stable or even decline. It's not a contradiction, it's a feature of how money flows through the system. And if Alden is right, if we're entering a new phase of gradual, sustained monetary expansion, then the implications are clear. Liquidity is returning. And historically, liquidity has been one of the most powerful drivers of crypto markets. So the real question isn't just whether money printing is coming back, it's whether the market is already positioning for it. If you found this breakdown valuable, make sure to like the video, subscribe to the channel, and turn on post notifications. And let me know in the comments, do you think the next major crypto move has already begun? Thanks for watching.